question is this. If Japanese equities can rally while currency intervention risk remains the main headline, is the market still buying the weekend story? Or is it buying time before officials force a reset? That is the difference from Friday. On Friday, the yen had rebounded on intervention fear and the Nikkei still moved higher. Today, the signal became stronger. The Nikkei 225 rose 1.47%. TOPIX gained 1.24%. Dollar yen was almost unchanged around 161.5. So the equity market is not rejecting Japan because of intervention risk. But it is also not trading in a clean, simple weak yen environment. It is trading with an official clock in the background. The headline flow was concentrated in foreign exchange. One story focused on how Japan's well-known currency policy figures are keeping traders guessing. Another focused on possible surprise tactics against yen speculators. A third focused on traders becoming nervous after recent yen jumps. The practical point is that intervention risk can influence positioning even before any intervention actually happens. A quiet dollar-yen session near 161 can look stable. But for investors, that level also carries a warning. The yen is weak enough to support exporters and overseas profit translation. At the same time, it is weak enough to keep political and policy pressure alive. That is why today's market breadth is important. The Nikkei rose sharply, but TOPIX also gained more than 1%. That suggests the market is not only buying a narrow group of index leaders. There is still a broader equity bid. But this confidence has a condition. If the yen moves lower slowly, investors can treat it as an earnings and competitiveness story. If the yen snaps higher because of official action, the market becomes a positioning story. Carry trades can unwind. Exporter assumptions can change. Foreign investors may need to adjust hedges quickly. That is where Toyota becomes the stock to watch. Toyota is a useful lens because it connects the currency story to the real economy. For a global exporter, a weak yen can support earnings translation and competitiveness. That is the constructive side of the Japan trade. But Toyota also shows why intervention risk matters for equities, not only currencies. If the yen is weak and stable, investors can model the benefit. If the yen is weak enough to trigger policy action, that benefit becomes harder to value. The question for Toyota is not simply whether a weak yen helps. It is whether investors are still willing to pay for currency-sensitive earnings leverage when the currency move may be interrupted by officials. This is a different stock lens from last week. Nomura was useful for asking whether currency volatility creates client trading flow or broader risk aversion. Toyota is useful for asking whether the exporter side of the weekend trade still deserves a premium. The next signal to watch is the combination of three things: exporter performance, TOPIX breadth, and financial sector resilience. If all three hold up while intervention fear remains high, then the market is saying the Japan trade can absorb policy risk. If exporters start to roll over on yen strength, or if TOPIX loses breadth, the message changes. It would suggest the cost of intervention risk is starting to outweigh the benefit of the weak yen. For now, the equity bid is still alive, but the character of the rally has changed. Japan is no longer just a weak yen equity story. It is a market being marked every day against the possibility that